Okay, good afternoon and welcome to the Knowledge Farm. As we gather here today, we acknowledge that we're on Treaty 6 territory in the homeland of the Métis. We pay our respects to the First Nations and Métis ancestors of this place and reaffirm our relationship with one another. My name is Ariel, and today I'm here representing both Innovation Saskatchewan and Innovation Place, following the Government of Saskatchewan's recent announcement of a single innovation agency in the province. We're excited to work together to advance our shared mandate of helping grow the Saskatchewan tech sector. We serve as the province's innovation catalyst with an integrated approach to providing programs, services, and infrastructure that support entrepreneurs, startups, research institutes, and tech companies. We're pleased to partner with AgWest Bio on the Knowledge Farm programming series. The Knowledge Farm is Saskatchewan's premier forum, producing connections that grow innovative ideas in agri-food and bioscience. To date, we've hosted 10 events since March 2022, covering topics of student entrepreneurship, talent, and labor challenges in bioscience, women in bio, and now carbon conversations in agriculture. Taking part in these discussions and initiatives are key to increasing the representation of Saskatchewan's tech sector and in helping our local companies and entrepreneurs scale and succeed. Thank you to AgWest Bio for playing a critical role in growing Saskatchewan's tech sector throughout their work in agriculture, agri-food, and bioscience. Our government's growth plan aims to triple this growth by 2030, and your involvement is vital to the success in achieving this goal. For everyone participating today and in the future, our collective efforts will ensure the province's innovation ecosystem continues to evolve and thrive. Now I'd like to introduce today's moderator for the program and panel discussion, Dr. Karen Churchill, President and CEO of AgWest Bio.
I will swallow the mic, as they say you're supposed to do. So thank you everyone for coming. What a great crowd, which obviously speaks to the quality of our speakers and how this topic is resonating with so many people. I'd like to ask our speakers if they would come up and join me. And we have Jason. We have Jason on calling in from Kansas. So welcome. Each speaker will have 7 minutes to introduce themselves and provide a short background about their role in carbon. So after their presentations, we will open it up to a panel discussion. So this is our time to grill everyone really hard about what's going on in this space. So joining us today, we have Logan Downing, co-founder and CEO of Carbon Assessors, Marty Seymour, COO of Carbon RX, and joining us virtually, I mentioned Jacob Penner, Soil Carbon Project Manager at Regrow Ag. Welcome, Jason. So we'll start with Logan. Logan is a trained economist and has spent the past 6 years working within the refined products industry across North America. Logan has pivoted his oil and gas commodity background into the exciting environmental commodity market by co-founding Carbon Assessors in late 2021, so very, very new. The company's been growing quickly and are now servicing large oil and gas operators like Suncor Energy and Shell Canada, to name a few. So thank you for coming in from Calgary today. Hopefully, oh, it looks like the snow's already stopped, so you should have a decent drive home too. Did you have slides that you'd like to speak to?
Yeah, I do. Hey, thanks so much for the introduction. Happy to be here. I do have some slides that I pulled together. I figured since I was kicking this thing off, I'd give a little overview on the carbon markets, how I like to think about them, and how Carbon Assessors and its clients like to think about it. So yeah, there we go. So this is just roughly our service offerings. We provide market intelligence, we create market instruments, professional services, we take credits to market, and then we also do remote sensing assurance on nature-based solutions. Some of our clients down there. On to the next slide, please. So a little overview on carbon markets. I think for this audience, having spoken to a few of you before, this should be pretty standard, but what we have here is high emitters, low emitters. The delta becomes the opportunity for trading, and then there's quite often an offset that can be traded within this system as well. Important to note is like there's different market types: cap and trade, output based, which is what we have in Canada, as well as carbon tax. Reduction mechanisms can be facility level benchmarks, industrial level caps, and then also absolute industrial emission reductions. So that's just kind of like the carbon market overview. Now we'll get into the difference between voluntary versus compliance. Next slide. There we go. So we like to think of this, okay, there's carbon markets. What are they? There's a compliance element to it and a voluntary. Compliance is what you have to, actually regulatorily meet. Price and quality are differentiated between these two market structures by quite a lot. So to give an example, the Alberta tier market, there's 146 million tons traded annually or regulated annually. We create the index at the moment. So last month it was trading at around $47 a unit, while the carbon tax was 50, meaning there's still a discount to paying out that tax. Another large compliance market is California and Quebec under the WCI program. So again, that's about 123 million tons regulated. So Alberta does have one of the largest carbon markets in North America, which is interesting, and not a lot of people know that. Underneath that, voluntary. So what we see in voluntary is that the volume of transactions increases dramatically, and also the price decreases dramatically. So underneath this, we have registries, which is what kind of looks after the different methodologies for creating offsets. There's a Vero registry, ACR, CAR, CSA, all these acronyms, but essentially they're kind of quality gatekeepers in a way. And Marty will talk more about that later. Underneath that, there's about 2.74 billion tons, kind of regulated or created under this schema. So quite a large market, global market, region spend across the world. So those two tiers are very important to keep in mind, compliance versus voluntary. On to the next slide, please. Okay, Canada, this one's fun. Look at all these different carbon markets, and almost none of them are fungible. Just let that sink in. Yeah, so as an economist, I look at that, and that's inefficiency. Inefficiency creates trading opportunities. Saskatchewan's an OBPS system under the federal, and it also has its own provincial element. So we like to call it a bit of a hybrid system. On to the next one. Yeah, I'll go over pretty quickly on this one. So the tier system is OBPS, which is Alberta's market. Rates drop or tighten every single year. So that graph is just showing the tightening rates that are being applied to facilities every single year. On to the next one, please. Okay, so we always tell people to act quickly in this market because of the government regulated contango. Prices are going up. So a quick example there, we have a gas plant against the best of gas benchmark. So we see it about $1.50 a unit, and by 2030, under the tightening of that gas, best of gas benchmark under the net zero plan, prices are going to go up to about $32 a megawatt hour. And that's for a gas plant that's recently converted from coal. That's pretty big for COGS. Again, for oil sands, we see about 10 cents a barrel. That'll go up to about $3 a barrel by 2030. So you want to act now, and you want to mitigate those costs as much as you can. And there's a variety of ways that you can do that. Renewable PPAs is the best one. I'll throw that one out for everyone. On to the next slide, please. Okay, so pathways to creating carbon offsets within the agricultural sector. So looking underneath this again, compliance market versus voluntary. So under the compliance system, the federal offset program is evaluating a protocol specific for enhanced soil organic carbon content mitigation. Details are pretty sparse on that, but you can definitely email them to reach out for details. Province of Saskatchewan looks like for next year, they're not going to allow offsets within their compliance system under the discussion paper that was released earlier this year from the government. The province of Alberta actually discontinued their conservation cropping protocol. They deemed the additionality of that protocol as not being sufficient to warrant an offset credit to be used within the compliant market. Voluntary, there's a number of different protocols that can be utilized to create offsets. And then, Marty's going to talk about Carbon RX and how they work with groups to create offsets as well. So again, compliance versus voluntary, steeper regulatory hurdles. On to the next slide. Okay, now we get into my kind of bread and butter. So carbon market value levers. So when we go to trade, this is kind of how we think about the market. There's a timing vector, quality vector, origination, and supply. Timing is all about understanding how you're going to buy, hold, buy, sell, retire, and the contango or backwardation in a particular market. So contango is just the slang for future price is higher than present price. If it's a contango market, you typically want to hold. Quality is probably one of the most important factors with the voluntary market. Understanding which registry it's coming in under, which protocol, which region, and which vintage really impact the price that you're going to get in the marketplace, as well as the verification body behind that particular project. So we'll go on to the next slide. All right, so some pricing here. So the top left is showing you the California carbon allowance price and futures price. So we have spot price, and then it goes into a backward dated futures price. It really ramped up into 22 there, just because of demand exceeding the supply of offsets, as well as offsets being kind of discontinued in that system or reduced. One of the most interesting ones that I've been following, though, is the ETS system out of Europe. So just with everything going on in Europe with the energy shortage, gas shortage, very fascinating to watch the futures curve on this carbon market. So when I was watching that in September, the futures market was well in contango. So there's like over $15 uplift. That was mid-September. Now, if you look at it, it's flattened out quite a bit. So pretty interesting to think that one through in terms of why that might be occurring. So is that the market signaling they're unsure of the validity of that market going forward? Or is this a signal that they think that they'll find the marginal supply of gas and remove the newly fired up coal plants from the market? Don't know, but it's really fascinating to dig into. The bottom left is the NGO contract. So this is something that would be fit underneath the agricultural protocols. So we see this market, the spot prices really decline because of the macroeconomic drags of inflation and interest rate increases, and energy price increases. But again, that market is well in contango. So there's a good viewpoint that future demand for these instruments is high. So important to keep note of. We'll go to the next slide. Okay, quality. So how do we think about quality, and how does the market think about quality? We'll think about it in three levers: permanence, additionality, and leakage. So is the project permanent, and will it remain permanent? Additionality is, would there have been reductions if this project had or had not happened? And then leakage is, have you just forced this work to go elsewhere? So the market really looks at, in all honesty, permanence and additionality. Like I said, the Alberta tier market axed one of their protocols because of a lack of additionality. And permanence is something that we definitely need to monitor. And as you go out into the market, you need to ensure that you are protected from permanence as a factor. A lot of people protect themselves through invalidation insurance is usually how it gets done in transactions. On to the next slide. Okay, real quick. So yeah, if you can actually demonstrate those three things to the market, there's huge upside. And I'm talking like almost $5-6 a unit uplift. So the opportunity is there to strike above the bulk price, which is kind of that exchange value. But you have to be able to prove out the permanence, additionality, and leakage components. Next slide. Great. Yeah. Last thing with going to market to go trade, you should understand your fundamentals pretty well. So where does the supply demand balance sit? We'll go to the next one. Are you actually understanding who your counterparties are? How often are they in the market? What's the spot volume liquidity in case you need to get out of a position? All those things. Next slide. And yeah, understanding price in these markets is very, very tricky at the moment. OTC or over-the-counter transactions or bilateral transactions are infamous for not being reported, and there are very few indexes built at this point in time. So I see a lot of opportunity for creating, market infrastructure. And I'll end my presentation with the next slide. There we go. Thanks. Yeah, you guys can go create a free account and check out some data and poke around. Yeah, lots of intel in there. Looking forward to Q&A.
All right, so our next, Marty, our next speaker is Jason, though. You guys share that one. I would like to introduce Jason Penner. Jason is an ecologist by training and a project manager by trade. Jacob leads Regrow's work to bring world-class science to emerging agricultural carbon markets. With over 3 years' experience in this emerging industry, he has quickly become an expert in the development, implementation, and third-party verification of soil carbon projects that unlock new revenue streams for agriculture producers. Welcome, Jacob.
Hi there. Great to be here, albeit virtually. And yeah, can you all hear me? Can you see my presentation? I didn't. Okay, yeah, I see thumbs up. Awesome. So, like Karen said, I work with Regrow. Let's see, I should actually present. And appreciate the intro. So really what we do at Regrow, we are a software company, an ag company, a climate company, whose mission is to make regenerative agriculture ubiquitous on every acre globally. And so sort of the way that we do that, we're a team of environmental scientists, of soil scientists, of plant scientists, agronomists, software engineers, sales folks, business development folks, product folks, policy people. So we really sort of attack this from a lot of angles, but to sort of place ourselves, I guess, within the lens that Logan just set. We work primarily sort of in the voluntary markets and where there is increasing interest in ag as a solution, and there's sort of more of these established protocols out there that Logan was talking about. So this is the team here. We, like I said, we're a startup, so I think we celebrated our 6th birthday earlier this week, but Regrow, really as Regrow, has been around for just a couple of years. That said, we already monitor nearly 200 million acres of land annually. We've helped sequester around 50,000 metric tons of emissions. And we do this using 3 product suites. And you can see a couple of the investors that we have that we've been working with down here as well. So the way that we tackle this challenge of making regenerative agriculture ubiquitous is through these three products, these 3 software products. And I will talk mostly about the MRV suite on this last one here, but just to touch on the first 2, Crop Insights is a platform that is grower facing and offers recommendations on how to sort of apply precision nutrient management tactics to improve crop yields. Sustainability Insights is a corporate facing software product that helps companies track and report on trends in their supply chains, and identify opportunities for investing and improving emissions reductions in those supply chains. And then the MRV suite is really sort of where the rubber meets the road between these 2. It is both a grower facing and corporate facing platform that lets our clients enable, launch, and run programs that will ultimately be verified under these protocols, if that is sort of the end goal of the client, by collecting the data needed to quantify these practices and outcomes transparently from growers. So we're doing all of this obviously because of the emerging opportunities in ecosystem markets and value chains as well. So Logan was talking primarily about scope 1 markets, and we do work in those areas, but really a lot of what we do also is in the scope 3 world, so carbon insetting. and understanding and helping companies to sort of make action against their scope 3 emissions, which for a lot of our clients being food companies is really the majority of their carbon footprint, 80 to 20 in a lot of cases. So obviously growing awareness of climate change brings these opportunities to the market. And these markets allow the agri-food supply chain to compensate farmers with transparency for their efforts in emissions reductions. And I think that last part is really sort of the key in our value sell in this area, is that markets, to be effective, need to be transparent with outcomes quantified transparently. Logan talked a lot about quality. I think that's super important, obviously. And it's been a tough nut to crack for ag projects in the climate space to date, really. There just hasn't been the technology in place to really sort of leverage quality, but then also keep costs down and do projects at scale. And that's really what we're trying to solve with this MRV platform. MRV stands for monitoring, reporting, and verification. So those are really sort of the 3 steps that we do while not being an official verifier per some of these standards like Vera and CAR, and I can get into that a bit more. But really, this is a platform, like I said, that is both grower facing and corporate facing. It allows growers to enroll and check their eligibility status. So a lot of these protocols have rules related to additionality. They want to see new practice changes, new practice changes coming in. So if you've been doing no-till or cover crops, you might not be eligible for a specific program. So really what we do is allow growers to sort of see their eligibility in real time when they log in and enroll. We are able to sync with a lot of farm management systems. So data that is already being collected on operations can be brought directly into the platform and used to sort of inform this eligibility assessment. We're then able to calculate a baseline outcome trajectory for each grower using methods that I'll talk about a bit in a minute. So sort of help them understand what their current outcome is and then what their potential outcome would be if they were to make these practice changes that they're considering. So if you want to switch to no-till, if you want to switch to no-till and cover crops, what's your trajectory? What's your output? What are you likely to gain from participating in this program? We're then able to track the adoption of these practices using remotely sensed data for things like tillage and cover crops especially, and I can expand on that a bit in the next slide. And then also able to quantify the actual greenhouse gas outcomes and soil carbon outcomes that these protocols are requiring project developers to report on. Using primarily models and a bit of sampling too, and there's a whole world there that we could have a discussion about if we want. The sort of last step of this, like I hinted at earlier, is to report on these outcomes and connect to third-party verifiers. While we ourselves are not an official verifier, we really sort of see this technology that we're bringing to the table as an opportunity to disrupt and improve the process of third-party verification right now. From my prior experience in this field, it's very spreadsheet-based, it's very intensive, it's very costly, frankly, to get to a point of an actual issued offset. Given the systems that have existed to date. And so really what we're trying to do is digitize this, scale things on a platform, code it all into place so that it is auditable and rigorous while not sacrificing time. So just to briefly touch on sort of the 2 tools, the scientific tools that really underpin all of this. These are Optis and DNDC, and these technologies are both sort of our proprietary tech products available only through Regrow. Optis stands for the Operational Tillage Information System. It's a pretty bad acronym, and I think we want to change it, but that's what it is today. And what it is a remote sensing algorithm that uses satellite data as inputs to machine learning algorithm. To identify everything visible via remote sensing, essentially. So things like field boundaries, crop types, tillage practices, cover crop practices, crop emergence. We use this in all 3 of the products that I discussed earlier. We're pulling from Modus, Landsat, Sentinel, all this publicly available satellite imagery that's taking a picture of the surface of the Earth every 3 to 5 days, and have extensive ground truthing available to sort of get us to the point of 90% accuracy, where we can say with confidence that yeah, we've observed that you did no-till on your field, that you planted a cover crop, and we're confident in that. And so that sort of, we see that as a new tool that has not previously been available to help with the monitoring and of these carbon projects. Logan talked about permanence, and a lot of that comes from sort of this one in ag projects, at least, this need to continue these practices to account for, to make sure that the carbon benefit stays there over time. And so with remote sensing tools like that, we can easily do that, eliminating really the need for a site visit is sort of our goal. On the other side, for actual quantification of outcomes, we leverage a model called DNDC, which stands for denitrification and decomposition. This is an academic model. It's a biogeochemical model, first developed in the University of New Hampshire back in the 1990s. And really what it does is take management practices as inputs along with info on soil and climate, and is able to predict using first principles of biology and of chemistry outcomes related to soil carbon sequestration, greenhouse gas emissions, nutrient use efficiency, yield, all sorts of things that are relevant to these protocols in the ag space. Given the model's 30-year history, it's been peer-reviewed in over 500 publications. It works from these first principles, so it's globally applicable, but then it's also regionally validated, and that's a lot of the work that we've done too, is to actually go and mine the academic literature, find all of these studies that have actually measured changes in soil carbon and greenhouse gas emissions under certain agricultural practices, and compare that to the model's ability to predict those changes. So by doing that, we leverage models and we leverage measurement without having to take extensive measurements on the field. Combining those two allows us to report and account for the uncertainty in these outcomes, which is another sort of thing that underpins a lot of these markets to date. They want you to be able to report uncertainty. They want you to be able to say that you are being conservative in the final number of tons that you're issuing and claiming. And so by doing that, we're able to meet those requirements. So this model has been approved by third-party standards for both Scope 1 and Scope 3 carbon projects, including under standards such as the Climate Action Reserve here in the US, and SustainCert, which is based in Europe, but is a global emerging standard and verifier for Scope 3 work as well. So I think this slide is redundant with a lot of what I just said. And then just to end with a real brief case study. So one of the clients that we work with is Cargill, and we have helped them stand up and launch several of their Regen Connect programs that maybe some of you have heard of, where they are really using this platform to do just what I was talking about. They're enrolling growers, they're incentivizing them to sign up for specific practice changes, and then we are collecting their data as they complete those practice changes to understand their success rates, to monitor the successful or not completion of these practices, and then to quantify the actual outcomes associated with that. So this is a Scope 3 program for Cargill. The outcome is that we will be able to report on those GHG emissions per unit commodity crop that is being grown on these acres. And that's something that Cargill will then be able to claim internally against their own corporate goals, or transfer and sell to customers up and down the value chain, which is really sort of the potential of Scope 3, given how supply chains work. So that is all I have on Regrow, and yeah, looking forward to the discussion here shortly.
Jason. So Marty does not want me to read his boring bio. He may regret that. I think a lot of us know Marty well because he's been 25 years in business development and finance, and the breadth and diversity of projects he's been involved in is amazing. So we have champion ballroom dancer, llama expert, how to convince people that wheat is actually is a healthy crop, a healthy grain, to being one of Canadian Western Agribition's top 50 in agriculture. It's pretty broad. So it didn't surprise me at all with your background in thought leadership that now you have embarked in the carbon territory. So we're all looking forward to hear about your latest endeavor.
Yeah, thanks, Karen. And when I look at that bio, and you guys, you wouldn't have seen it, but she had it on the sheet, and I do, it is kind of boring, but it really exemplifies I can't hold a job. If you look over my 25 years of work, every 4 or 5 years, I've grabbed onto something new. And what I do need to share with you is sort of how I got here. And so in April, I left the warm security blanket of Farm Credit Canada, Crown Corp with the pension plan. And I said, I'm going to go build a business in the carbon space. And what my motive was I was attending events like this all over the country on behalf of FCC. And I watched farmers sit there and say, we need a piece of the action in this carbon thing. And at the same time, I was watching companies like Maple Leaf say, I just want to buy carbon credits locally from people in my supply chain that I deal with. And I was frustrated because nobody was doing it, or to my perception, nobody was doing it. So I'm like, double down and I'll go and build this company. And a month in, I realized why nobody was doing it is because it's hard as hell. And so I've had some learnings, and I got a chance to meet Logan a month or two ago, like my network's changing, and I'm meeting some really interesting people in the space. But my motive here was, you know, I farm on the weekends. We have a family farm in the southeast part of Saskatchewan. It's small and humble, but my chairman farms a significant amount of land in around Regina area. And so we had a farmer perspective on how to solve this carbon thing. And what I've come to learn in everyone I meet is we've either approached it academically from a scientific standpoint and pushed it top down, or we have approached it from a purity standpoint, and the purity being the compliance market saying, I want to sell a $40 product. And so we've specialized at Carbon RX in the voluntary carbon market, which if you're just learning about carbon, it's kind of simple. The compliance market's regulated, governed, highly managed, lots of integrity all throughout. The voluntary market to me is like Kijiji, is two people agree on the terms of the sale. And so if you think your bike's worth $100 and I'm willing to pay it, that's the basis for the voluntary market. So my desire isn't to build a voluntary solution for farmers that bastardizes the quality of the credit. It's to build one that works for farmers. And so some of my learnings, and I think our Q&A can kind of get here, but some of my learnings on this within the carbon space, originating credits, is we're using protocols that are 10 years old, 12 years old. It was good science at the time, good thinking at the time. But if I look at the advancements in data application in agriculture, a few weeks ago, I was speaking to a group, and it struck me that carbon's not a climate play. It's not a sustainability play for an industry. It's a data play. So the stuff you guys work on at AgWest Bio and advancing data and measuring and all the other groups I see, that's really at the anchor of how Canadian agriculture is going to engage is by applying the data. So what I've tried to bring to this sector since I've started building this company is take the complexity of it and simplify it. So if we just know it's about data, let's start there. If we know the protocols don't use the latest technology around satellites or drones or how we do soil testing, let's start there. So we're kind of early in our journey. We've been at this since April, but having some wins and realizing that some fun stuff. I get a call at every couple of weeks from someplace totally random, and so a gentleman called me from Taiwan and said, Marty, we need 50 million credits to service our market here. Can you help me? That's a lot. You don't have to know anything about carbon, but that's a big number. So I did some quick farmer math on the conservation cropping protocol that was referenced in the talk. And if every acre in Canada participated, we could produce 16 million, 1/6. And Taiwan, this small little place producing semiconductors, is 50 million. So inside of that is our opportunity as an industry. And what we've got to do is disrupt a little bit of the convention of how we originate carbon. I'll just say, think more progressively and more modern. And a byproduct of some of our work was I realized that the modern registry system is a little bit dated in terms of its approach. And on the side of my desk, we're also building a company to modernize the registry approach. And I was just talking to Michael beforehand from Ducks about what the beef group did around sustainable beef, and said the industry got together and said, this is what sustainable beef means to us. We have the same opportunity in agriculture, forestry, hydrocarbons to say, this is what a carbon credit means to us in the voluntary market. And if the industry decides that that's what it means, then that's good enough. That's how most certification bodies work. The organic industry was sort of anchored in that, is, well, what makes organic farming? A bunch of really smart people got around the table and said, well, if you meet these criteria, then that's organic farming. Carbon can do the same. So So my call to action in Canada, which is my sort of my local family, is to engage and participate in a modern carbon registry that starts to move at the speed of business, more predictability in the approval of carbon credits, drive some costs out. Because we really want farmers to engage in this, we have to leave money for the farmer. Because historically, the only people that really ever received any revenue from this were the aggregators or the people like my company that helped you get the credits. There's never no money for the grower. So you know, the obvious one that I'll get challenged on is this greenwashing the carbon sector. Is if we do an industry-led initiative or tackle it, is that the outcome? And my observation is we have an opportunity as an industry to get paid for good work and attract non-government money to do it. And so in the early days, we'll have incremental improvements, how we farm and how we manage the soil. But if we take a regenerative soil approach, attract outside money to support some of the management practices to do it, I think it's like a flywheel and it gets some momentum and we can start to really transition our industry into this space. It's coming on the backside of COP27. It's the topic. And it's going to be like this for the next decade. I think, you know, I bet my career on it because I think it's an emerging issue, but I do want to be disruptive in how we solve it. So I'll maybe let us get into the questions. That's where the real meat is going to be here.
Questions, but we'll maybe start with Logan. And from your unique perspective, how do you see Canadian agriculture fitting into the existing or future carbon markets?
Well, I think Carbon RX is doing a good job of that. In terms of the compliance markets, I am unsure as to what will exactly transpire with those. So at this point in time, it really does seem like a voluntary play. So within that, I think the key is permanence, you know, establishing the additionality. And to Marty's point, it can be data driven. One of the major registries just at COP27 has now finally acknowledged that remote sensing can be used. Like, that's wild. I mean, I even have a climate scientist on staff, and we're basically like commodity guys, and we've been able to go out and look at land mass because that's our own due diligence. And so the registries are just finally starting to catch up. So what I would say is you know, work with guys like Marty and create a homegrown solution. You know, in Alberta, it's not quite the same. We have a compliance market, but it is the province of Alberta that's regulating it. And so they created a bit of a unique solution for Alberta oil and gas because the federal solution wasn't going to work for them. So I'd really, you know, pull from playbooks that have already played out and learn from them is what I would say.
I know it's not working, so maybe you could ask the question or just chat here.
Jacob, what do you think about
Sure. I admittedly know the least about Canadian markets in particular from anybody in this room probably. So I won't pretend to be an expert here. The one thing I do want to highlight in thinking about this question is this emerging notion of scope 3 markets as sort of an alternative to scope 1 markets. And you know, we really see that sort of as an appeal for a lot of our clients. Food companies that, like I said, realize that 80% of their emissions come from their scope 3 emissions, as opposed to the traditional offset markets that serve primarily scope 1 credits. And we see groups and standards like Vera expanding and realizing the need to sort of come up with a scope 3 solution. I think the key question there is going to be to Logan and Marty's point, like what the ultimate value is for the grower. Because really that's, you know, who you need to convince to come on board at the end of the day. I do think that the exciting potential for scope 3 is really the whole the process by which scope 3 by commodities are propagated and sold, you know, throughout the supply chain. So there's the potential to sort of claim and cash in multiple sort of steps of the process. If you're a corn grower, if you're a wheat grower, any company that uses that commodity product at some point throughout its life cycle has a scope 3 footprint that's associated with your commodity crop. And so there's more buyers for the same unit, frankly. And while those markets are much less well defined, I think that's sort of an exciting direction that we see the market going.
I want to pick up on that, Jacob. I'm glad you raised scope 3. For my farm lobby friends in the room, pay close attention to scope 3. It terrifies me a little bit because we'll make sure we come back to intensity-based protocols. I think that's our real opportunity. Scope 3 scares me from the standpoint of, I think Maple Leaf was the first one that introduced this to me, and I have a lot of respect for the company. I'm only using them as an example. So you grow hogs, and Maple Leaf says, well, I want to be net zero by 2030. And they go up their supply chain and say, my barley, I would like to know its footprint for barley. And I look at all my ingredients and I claim those against my footprint. That's the whole point of scope 1, 2, and 3. The challenge with it I see as the farmer in me is if they claim my carbon credit, so I do good and I put some carbon in the soil as part of my strategy, and Maple Leaf says I would like that in my supply chain for my offset. Jacob's example with Cargill is exactly that. We'd like to apply it against our own footprint. Can the farmer get paid for that? Is one, because if the company's claimed it, he can't sell it twice. I think the blocking strategy for the industry is to talk whole farm, because that's my observation here is like, if I'm running a farm with 2 crops or 3 crops or so on, some are sequestering carbon, some are barely neutral. A high nitrogen intense crop is a big environmental footprint. So if I give away the barley, which maybe had a net benefit to carbon sequestration, but I was growing corn or I was growing canola, which was contributing, I've compromised my farm because in theory, I'm supposed to pay a penalty someday on the carbon footprint of the canola. So what I want my farmer friends to think about is think whole farm. It's how you run your business. It's how Maple Leaf runs their business. They think slaughter, they think electricity, they think trucks. But if you align quickly to scope 3 in the value chain, you'll lose your negotiating power. And I'm not here to lobby. It just strikes me as a gap in the industry that's coming at us and we don't have a plan. I'll stop there. I can go on forever on that.
No pun intended, the grass is always greener on the other side. How about Saskatchewan? How savvy are we in this conversation? On a scale of 1 to 10, are we barely getting started? Are we way behind Alberta? And frankly, globally, does anybody even know we exist?
No, I'll go first because I actually love to hear from my Alberta friend on this one. My learning is every room I go into, I have to start with a carbon 101. And I do it respectfully because I realize people are all over the place on their carbon knowledge, and nobody should be ashamed of that. So in Saskatchewan, we're at grade 2 level in terms of the carbon journey. When I need expertise or when I want to feel over my skis, I phone Alberta because they've been at this for 20 years. They've got acronyms I'm still figuring out. They're really sophisticated. So if you need expertise, you phone Alberta. But Saskatchewan, it's kind of been an anti-federal play to not really engage in the conversation. And so our industry's not there either, honestly.
Yeah, I'm not going to say Alberta's more sophisticated than Saskatchewan. That won't go over well, and we have to have beer after this together. But what I would say is there's definitely leading examples out there. So European Union is definitely probably a decade ahead of where most of North America is. Behind that would be the California cap and trade system. I say that just because it's a very fungible system. They've introduced voluntary offsets as a mechanism to meet some of the compliance. There's market instruments, so it does trade fairly well. Behind that would be, you get into your biofuels, and then you start to move into Canadian markets. Calgary has a lot of trading expertise on commodities. So it's typically the electricity traders who were first at this. And now you're seeing oil and gas traders kind of move into this space, like myself, and start to explore it. So that's kind of the evolution. So when I think about who to look at, I'm looking at Europe to see what's coming up next in terms of policies. They're thinking about ways of carbon, like basically creating an FX at the border so that you can ensure leakage doesn't occur cross border, right? And that's miles and leaps and bounds ahead of where we're at the moment. But yeah, that'd be my 2 cents.
How about you, Jacob? Saskatchewan, challenged or opportunity?
I'm gonna have to pass on this one. I'm just not in the know on Saskatchewan specifically. I mean, I know that Alberta has.
That is the answer, Jacob. Question I have is, how can today's science and technology ensure that outcomes accounting is accurate and robust? And does this accuracy change from crop to crop or region to region? Actually, I would like to start with you, Jacob, because this region to region thing is quite interesting to me.
Yeah, and you know, in looking at that question, I think obviously accuracy and robustness are paramount, but then also the scalability and the cost associated with achieving that accuracy and robustness is just as important. And I mean, that's essentially what we're trying to do at Regrow, is leverage these technologies like remote sensing and biogeochemical modeling that eliminate or severely reduce the need for cost-intensive soil sampling. I think a lot of these programs in the ag space have been built on soil sampling historically, and you know, it's sort of assumed to be the primary source of truth. But in reality, there's obviously a lot of uncertainty associated with the soil core every time you go and pull it. And the cost associated with it just doesn't scale effectively as well. So I think it's important for us to sort of shift away from soil sampling as the gold standard and realize that there are associated uncertainties that are sort of problematic to overcome, but really sort of leverage measurements and modeling together. And to your question about crop by crop, region by region, I think, you know, there's a lot of different models out there. And the advantage of something like DNDC, the model that we use at Regrow, is that it's based on these first principles. And so, you know, there are regional differences, obviously, in soils and climate, in crop systems, but the same first principles really operate in all of them. We have photosynthesis and crops that grow and sequester carbon and then decompose and release that carbon into the soil where some of it sticks around. So these tools that are really built on these first principles, I think, are going to be the most scalable when we're sort of taking a regional approach or even a global approach, and that's sort of what we're banking on, at least.
Yeah, I'd second that. I mean, remote sensing, I think, is by and far the best technology to cover the most land mass. Spatial resolution is a pretty big problem. Temporal resolution as well. You kind of need a constellation at some point. That's where we got to anyways. But if you can solve that, then you're actually looking at this dynamic system live, and you can make live adjustments. What I would say though is policy definitely lags that, as we're all well aware of with the various discussion papers that are out by the federal government. And yeah, I think, you know, we got to intersect these things at some point in time. So I'm a bull on market systems innovating. So definitely want to see that happen more and more.
Yeah, and the innovation comes faster in the voluntary market because it's really just the free market responding to the need. So the buyers are looking for an attribute, we'll invent the sensor to solve that. And so I'm actually inspired by that too. I think that'll happen. I want to talk, you know, Jacob was talking about sampling. And so I've come to learn at the ground truth level is there's a 20% variability amongst labs in a soil sample. And so we've built this industry around testing soil and using that as our baseline for how much carbon's there. But between the labs, they can't agree. So now we show up and say, well, we'd like to use a sensor, or we'd like to use a modern technology. The soil people they've got rakes in the grass saying, well, you can't do that because it's not as reliable. And so I think in this entire thing, as we chase perfection, we're actually fooling ourselves. And so crop by crop, region by region, I like the idea of coming up a level and I said whole farm sort of dilutes the crop by crop. You need the data, but you have to think whole farm. Alberta breaks it into soil zones. You know, how micro do we need to go to still satisfy the buyer that the data we have is good enough? Because I think we're spending, you know, it's the old 80-20 rule. It's the last 20% of spend is gobbling up all the margin. The first 80% of data we gather, it's actually pretty good. It's the last 20 that paralyzes us and leaves no money in the system.
I completely agree with that. And I think that's where I think that's where this notion of uncertainty comes in. And, you know, as long as we're able to report uncertainty, I think a lot of people let the perfect be the enemy of the good and are convinced that we need to get to a single number that will never change. If we can get to a point where we have a number with a range of error or margin of error, I think markets are comfortable with dealing with uncertainty like that. And to that point, I mean, we don't need to go chasing that single number. We can present data and outcomes with associated uncertainty and let the markets sort of solve the question of the ultimate value based on that uncertainty.
Yeah, kind of building on that, like the market will price in discounts for various quality tiers. That's super common. People know how to do risk adjusted returns. That's fine. One thing I'd point out though that's of interest and that we're actively monitoring is definitely that trust element, right? So as we scale the supply chains, we have to also keep in mind demand centers and where is demand coming from and why is demand there? So we have net zero targets. We're starting to see companies being sued in Europe, again, looking 10 years ahead for not meeting their net zero targets. That'll be a source of demand for voluntary offsets. But aside from that, if we're going to do this well, we need to weave in carbon into our economy well. So we need to figure out ways of integrating this into branding strategies and really creating some more benefit for consumers of these products at the end of the day. I don't think we've done a great job of accessing the wholesale and retail markets at this point. It's largely just bulk. So Microsofts and different companies like that are big buyers. So I think that's just more of a challenge for folks in the industry as to how do you access those small, medium enterprises who are experiencing 8% inflation and need to make the choice to either buy offsets to offset their emissions or increase salaries, right? Like, I mean, these are tough, realistic choices that we'll have to overcome as an industry.
What cements this for those that still aren't bought in is sustainable financing and access to capital. So I'm rather ambivalent of what the government chooses to do on carbon policy. I actually don't really care because, as I said, I'm in the voluntary space. It's the kijiji of the markets. But what does motivate me is if the teacher's pension fund gave you $30 million to do an expansion of your plant, and you said, I'll do that, and in 2030, I'll be net zero. 2030 comes along and you aren't net zero. The class action lawsuits that'll come from retail investing will paralyze companies' growth plans. So the stickiness for me that all of this is attached to finance, that's the sleeper in all this. If you want better rates, BMO launched a product 2 years ago to offer a line of credit to a major company. And it was not your conventional discount they got up front. The discount was realized after they hit their promise. Annually, they got, it's almost like your pharmaceutical rebates you get in big pharma or ag chem. So banks are doing this and looking at it more. That to me is the stickiness of this that drives the voluntary space around ESG investing. So you talk about carbon, you look at it head on like a climate play. It's a data play backed by money, a finance play.
From the audience who's not shy, would like to start with a few questions and not let me hog the floor.
Now, like you just look at Saskatchewan, and look at average farm, how many farmers have actually in that surplus of carbon credits that they can monetize? Do you have any idea on these numbers?
You want to maybe repeat the question too?
Sure. So the question for those online was, do we know in Saskatchewan how many farmers have a net surplus of carbon? I actually don't. I have seen some data once by crop on where it sits in terms of carbon footprint, but I actually don't know the number for Saskatchewan, where it sits. I don't know, just anyone else?
Sorry, man.
So from each of your companies, though, who's your target customer? Are you targeting growers directly, or are you more interested in the middleman or the educated farmer? Which
Yeah, I can speak to that. More of the economics of it is, this is a little bit of a volume game. And I think what set the temperature on that was the Alberta protocols, the compliance protocols that gave us 0.2 tons of carbon per acre. Is by the time I show up with a truck and a soil sample kit, I think you need 10,000 acres to make the business case for it. You know, long term, the money's there, but in the short term, there's just not enough money for everybody at the table. So I'm not answering your question directly in terms of footprint, but if you just looked at who will be the first movers, I had a call from somebody in Archerville, Saskatchewan, just a week ago. They do the random website. Hey, can I participate? And I probably get those most proactive, a small footprint person. My comment was, we'll be there for you, but not today. So if the threshold's 10,000 acres and Jacob does well with his technology, we can scale this thing, you know, and we get the sensors at the ground truth level. So to me, if you have 2,500 acres, you want to participate, is there's room for you, but maybe not today. Maybe it's next year. My advice is soil test. Regardless whether you like that technology or not, get a baseline. I can't help you unless I know what your original, your carbon number was, your organic matter. Do that. That's my one call to action to anybody listening that's wants to play but doesn't know if today is the time. Just do the test. Use it to drive agronomy and make decisions, and put it in the bank. And we'll see you in a year, 2 years when the technology makes it scalable.
I would just say to answer the original question, like our clients are the project developers in the space who are launching these programs. And so, you know, sometimes these are companies that have a long history of developing carbon projects, because there is that sort of specific sector of companies that have done this for 20 or 30 years. And then in other cases, it's companies like Cargill who are much newer to the space and don't necessarily have the experience getting a project through third-party verification, but are have the capital to try and make that effort. And so while we don't sell to growers directly, we do have, you know, a team of agronomists on staff, and we're designing the platform realizing that growers are going to be the ones in it and who are sort of ultimately providing feedback to the Cargills of the world on how their experience is, whether it's intuitive. And so, you know, we sell to the customers through their, or to growers, I should say, through their experience in the platform. And it sort of needs to come back to us through the program run by the CPG.
Yeah, I'd say there's two parts to our business. So part one is we create market instruments and make markets more transparent. So anyone who's operating within these markets is a potential customer, whether it's pricing, guidance, forecasts, understanding supply demand balance, all that good stuff to inform your trade strategies, go to market strategies. And then on top of that, we were able to monetize our insights for customers that are looking to find demand centers, consistent demand centers to sell their offsets to.
Just to build on your question, we didn't get to it earlier, is the industry needs an intensity protocol. And this hit me from my parent company, a company called Delta Clean Tech, specialized in carbon capture, and it's my parent company in industrial systems. So imagine a big smokestack. They help you scrub the carbon out of that and play in the compliance market to what we learned early on. So in agriculture, we've approached this as don't till the land, kind of a tillage approach, capture carbon in the soil. Why don't we approach it like the oil industry and look at it from intensity? So instead of fighting this war over nitrogen and fertilizer reductions, is what if we doubled down on nitrogen and grew twice the crop? Right now, that's unpopular as far as federal policy, but if we grew twice the crop, we also have twice the root mass, which means there's carbon that was just put in the soil. What if we implemented new technology that allowed variable rate fertilizer? What if we use less fuel because we bought a 10-foot bigger sprayer? And we approached it from an intensity standpoint so that we grew the crop with less fossil fuel per pound, per ton, pick a number. That's the gap in the industry. We've approached it conventionally, 10-year-old methodology around get the carbon capture in the soil, but why don't you approach it like the oil industry and just reduce your footprint? That's a carbon credit. In the voluntary market, I think it's very sellable. I'd be interested in your thoughts if it's discounted or where it sits, but it allows us to grow more food, which is a Canadian value, and not be put in the penalty box because our inputs are up. So I don't know, thoughts?
Yeah, off the top of my head, I'd say, well, you start to butt into the compliance market, which I think is actually could be a benefit to everyone. Much higher pricing. You get access to huge demand centers of all the oil and gas producers. why I say it butts into the compliance market is because you start to go and reflect that output-based pricing system, which, as you correctly pointed out, is exactly how oil and gas is structured at the moment. So it's all in emissions intensity per barrel production. Now, the flip side of that is you're going to need someone with thought leadership to execute that on a political level to actually get that across the goal line. And the, devil's advocate argument for that is, well, you can increase your total emissions base, even though you've reduced your emissions intensity. So challenges, but it's working in oil and gas, and it's one way that they've been able to systematically start to reduce their emissions intensity over time in certain sectors, mining being the most difficult, in situ is a little easier. Yeah.
This is mainly for Marty, but others are commenting about the voluntary market. And I've been following this market and been involved from a farmer input standpoint for 15 years or more. And 15 years ago or so, there was a Chicago Climate Exchange experiment, if you will, into voluntary markets, and using Saskatchewan farmland as one of their offset credits. Since then, there's been many other examples of it, I think, that I don't not get fully aware of. But the biggest pushback comes from these companies that have the checkbook out, maybe write some checks. Then their shareholders find out that these credits aren't real. It's called greenwashing. And that it's real in this context of trying to make a difference in the world, not just trying to find a way to move money from people that have it to people that want it, and for whatever reason, to actually make a difference. And that additionality was mentioned on your slides, but it's like, well, that's just one little thing. No, that's why only one of many things that reason why Alberta canceled theirs, but it's the main reason why the federal government didn't accept it for no-till protocols now. Regenerate Ag, as Jacob is describing his work, and it has some examples of that's going to be accepted to some extent, I'm told, because it's new. And it's a higher level of sequestration, and they want to encourage it. The whole thing is to incent change. Minimum tillage isn't going to be incented by a buck or two an acre carbon credits anyway. And what are these companies going to do when their shareholders push back?
Yeah, I'll touch the futures market component of that, and then I'll pass it off to Marty to talk about, and then also Jacob, because I think he can add a lot. Yeah, futures market. So what I'd like to say is that, so there are various exchanges that have formed. There's one in Singapore, one out of CBL Expansive, which is a New York, Houston-based group. And then on top of that, Chicago has futures contracts that are now settling on that CBL Expansive spot price. Fairly liquid. There's like over 20 million offsets that have been traded on certain futures contracts out to 2025. So there are ways to implement price risk management strategies. So that's good because the market then gets signals, bankers get signals, capital understands and can put into their discounted cash flow models how to fund projects. Now over to the tough part of that question.
Yeah, you took the easiest lane on that one. So for those listening, I'll summarize the question as kind of the greenwashing effect about if we don't do this well, the buyers won't like it, they won't buy them, they're devalued, etc. That's what I'm really hearing. Yeah, and I'm not advocating we take that path around greenwashing. I think we're going to walk a fine line. In many ways, my off ramp to that is to redo the book a little bit and say, let's talk intensity. So if you said, well, we can play the intensity card to a certain degree, to the point where our fertilizer use is just off the charts, unacceptable. I'm going to let the market tell me that, and let the buyers tell me. They'll tell it through the discounts is how, and probably want to do that before I've already sold your credits at a discounted rate. I want to know the answer to that. But to your anchor question is I just think it behooves the industry to be proactive in this space and set the temperature of what we're capable of. And all I've come to learn is we're not actually doing anything on scale in the industry because the economics haven't been there. But let's not be naive. You're never going to change your farming practices to give up 6 bushel of canola. But the economics of that are way outside chasing carbon and climate. So you have to find this fine line of, soil health, and then finding a way to monetize that data and sensor strong, because it's the only way there's going to be any money left. it's just a new revenue stream. It's how do we do it efficiently? It's a good question.
It is. And I would only add that when we talk about intensity, to me, that means scope 3. And so I'm sort of back to that as sort of a key solution here where, again, it's a bit trickier to sort of think of the concept of a credit within a scope 3 world, I think. But, you know, where these are sort of emissions that happen every year and, you know, companies are buying commodities every year, being able to say that the intensity of your footprint, if it is the entire, you know, wheat growing region of Saskatchewan, is going down over time just due to investment and uptake of regenerative practice within that region. I don't think that additionality becomes as key of a component there. It absolutely is in the scope 1 market. If you're going to sell an offset and claim that you're, you know, net zero because you emitted a ton and paid somebody to plant a tree somewhere else, my goodness, you need additionality. I think, you know, how that gets defined and applied in a scope 3 context is a bit trickier to sort of to discern. But I mean, I think that is part of the opportunity of this intensity-based approach.
I'd also just add real quick an anecdote. So a mentor of mine used to trade these credits 20 years ago, and they wouldn't even do soil testing for no-till. They would just they'd be sold these credits, and then they'd find 2 years later, you know, someone had actually gone in and overturned the permanence of that particular asset, right? That was 20 years ago. Now we see platforms like Regrow, blockchains forming marketplaces like Kijiji, more sophisticated market understanding with futures curve. So I think there's an evolution in terms of how we even think about this problem as well. So I guess I'm optimistic that we'll be able to integrate these lessons learned and iteratively get better at avoiding them.
I'll give you one last, I know you've done one last 10 minutes ago, but so given there's a lot of lingo here, additionality, that big businesses are needing to control their scope 3 emissions. If you're gazing into your crystal ball, how urgently do growers and SMEs need to educate themselves about this?
Yeah, yesterday, this is was the Japanese proverb, best time to plant a tree is now. If it wasn't yesterday. So I have this hypothesis is that if you're not sure what to do, soil test, I've already shared that. If you have the ambition and you're up for the journey, is go get your credits and get them in a bank account and sit on them. Because I think the principles of additionality mean they'll be progressively harder to get. Logan and I were debating this maybe last week already about don't hold them too long because old credits devalue because the market's looking for additionality. And so there's this weird paradox going on where I'm advising people, you know, the protocols today are probably more forgiving than they're going to be in 5 and 10 years. So get involved. And then quietly, I want to put them on my bank account, sit on them for 5 years and watch the market go and sell them as a hedge on my farm. You'll have some more insight onto why that is a good and bad idea. But the last piece I'll say on that is most farmers in Saskatchewan that I've talked to always want to backdate 20 years of zero till. I came in here thinking I could do that. In 2 weeks, I realized that, oh, that's not going to happen. So I let that dream go. And so last month I said, well, let's go back to Paris, December 2015, that's day zero, when whatever you've done since then is additional and we'll give you credit. I since learned from people that involved in the trade is those credits aren't that valuable. They're 7, 8 years old and people are looking for what have you done for me lately? So that's the paradox we're in. I'm still prepared to go back that far if the industry says in food production that makes sense. I think it's worth asking because worst will happen is the market will say we don't value them or they're devaluing, but it's still net revenue for a grower.
Yeah, I just kind of build on my last sentiment. The market's evolving very quickly. So what you're seeing is the older vintages are being discounted because there's a perception that the additionality and permanence are low because those particular protocols 5, 6, 7 years ago had, there's less hurdle rates on actually getting those passed. It's fascinating, right? You enter this cycle of innovation and change that's going to keep driving up the spot price of units. Now, something that's happened just more recently that I think is really interesting is we've now entered our first kind of business cycle within this particular market, which is pretty interesting because I think back in 08, 09, it just kind of collapsed. So that's kind of neat. We've reached maybe a critical mass point where there's actually some resiliency to go through a business cycle. So that's maybe not long term, but I would say my only tidbit of advice would be find a trusted partner and work with them. I don't think going out and just securing your own assets and holding onto them is wise. I think there's too many pitfalls. So find somebody who you trust, who knows the space, and just work with them like you would with a traditional broker or a Cargill, for instance. Over to you, Jacob.
Yeah, I wouldn't add too much to that. I agree with all of that. Prices are going to go up, but rigor is also going to go up long term. Hopefully barriers to entry go down as more tech solutions come online. But yeah, having that trusted advisor, I think is sort of the key piece. Just, you know, given the complexity of actually getting a credit to market.
All right, well, thank you. I think we should end on that plant a tree now thought. It seemed appropriate. And thank you, Yanni, for coming. And thank you, Marty and Logan, for driving here. We really appreciate having you in the room, and Jacob for making some time in your day as well. All right, and if you'll join me in thanking our speakers, then also join us for having a last drink. I don't know if we can ship you some cookies, Jacob. Thanks.